What's up guys? Welcome to today's video. Hope you guys are all having a wonderful weekend so far. So today's video is going to be specifically talking about credit score, how to build it, and basically what you want in order to qualify for the best interest rates. So in today's video, I'm basically going to give you a little backstory on how credit works, the 6 factors or categories that basically affect your credit score, and then obviously how to fix it in order to prepare yourself for either getting a house, refinancing a house, or if you just want to build your credit score in general. So sit back, relax, enjoy the video, and we're gonna jump right into it. So I've been doing a lot of research the last couple days. I thought I had a good knowledge of just credit in general, but there's so many things that I've learned over the last couple days, specifically prepping for this video, that I wasn't aware of. So I'm gonna have some fun filming this for you guys, and hopefully this will help you out. The best way to start this video is basically breaking down how your credit is built. I feel like this is the best foundation, and it gives you guys a good idea on what you want to focus on. The first 3 things that I'm going to mention here of the 6 categories are considered high impact. So these are the things that you guys want to focus on the most, and make sure you don't really default on any of these as well. We'll go into more detail on that later. And then the final 3 of 6 that I'm going to mention are considered lower impact. They still do have an impact on your credit, but not as much as the first 3 that I mentioned. If you guys do want to aim for like an 800 credit score or high 700s, low 800s, you want to focus on all 6 categories. Now this will take some time, and it's almost like a puzzle to try to get that like perfect credit score, which there's not really a reason you want. I mean, if you're in the high 700s, there's not going to be a big difference at all, if any, if you're trying to get to the perfect credit score. But just in case, you do have to focus on all 6 of these categories. The first category that we're going to be talking about here is the most important, I think, and this is going to have the biggest impact on affecting your credit score, not only short term, but long term as well. And this is called credit utilization. I'm just going to go through all 6 right now, and I'm going to break them down a little bit more in depth later on. The second category is payment history. Third category is derogatory marks. If one of your credit cards or one of your credit lines or one of your lines of credits goes into collections, that's going to drop your credit score big time. The fourth thing is the age of your credit, or like the average age of your credit line. So if you open a credit card 10 years ago and you open one now, they're going to average all that out, and that's going to be the average age of your credit cards. The fifth thing is the total amount of accounts you have or lines of credit you have. I know that sounds really stupid, but honestly, the more lines of credit, the more credit cards you have, the better off it is for you, as long as you're making payments on time. And then the 6th and final thing is more of a short-term thing. It's the total amount of inquiries you have. There's 2 different types of inquiries. There's soft pulls or soft inquiries, and then there's hard inquiries or hard pulls. We'll break that down as well. But we're gonna jump back to the very first category that I talked about, and I wanna spend most of this video talking about this, and that is credit utilization. So I'm sure when a lot of you guys open a credit card, you guys see the max limit or the max amount of credit, a line of credit that you have. For this example we're going to use a $5,000 credit limit. Credit utilization basically looks at how much of that $5,000 you are using each and every month or each and every statement. So in order to get a good to excellent credit score in this category, you want to have a credit utilization of under 30%. The best category possible is keeping your credit utilization under 10%. And what I mean by this, if you have a $5,000 line of credit, if you use $500 every month, you do 500 divided by $5,000, and that is 10%. So you don't want to go above 30% credit utilization. If you want under 30% credit utilization on a $5,000 line of credit, each and every month you don't want to spend more than $1,450 on that specific credit card. Once you start getting credit utilization into the 50%, if you're spending $2,500 of the $5,000 of your line of credit every single month, then it starts knocking your credit score down. You start getting into the poor or average categories of your credit score. So a quick fix for this, and a lot of you guys are going to be able to benefit a lot from this right now. If you guys do see yourself spending 50-75% of your credit line every single month, the easiest fix without actually changing any of your cost of living or anything like that is to prepay your card. So the way they look at your credit cards, they look at the end statement every single month. The best cheat code around this is just to pay it off before your statement's due. You guys should be paying off each and every month your credit cards in full if possible, unless you're dealing with a tough situation. But I always suggest paying your credit cards off in full no matter what. And the best way to do this is just pay it off a day early. Pay it off every single week. But don't wait, especially if your credit utilization is above a 30%. Don't wait until the statement's actually due to pay it off, because that's going to cause a slight impact on your credit score. Obviously, if you're trying to improve it, the best way to do it is just each and every week, look at your credit card, pay it off week 2, pay it off week 3, pay it off week 4. That way when the statement comes, your credit utilization is either at 0 or very, very low. So what I like to do is I like to pay it off a couple days early. I do like to leave a balance on it, even if it's $1 balance, just because that'll help with your payment history later on. But paying down your credit, prepaying your cards early will have a huge impact on credit utilization, and it will really help boost your credit score. The second category is payment history. This is pretty self-explanatory. A lot of you guys are already aware of this. A lot of people tell you when you get a line of credit to don't miss any payments, because it does have a massive impact on your credit score. This is one of the categories that can really drop your credit score within a matter of a month, 2 months, 3 months, and it's extremely hard to correct this just because payment history stays with you for a very, very long time. Basically, the only way to improve your credit score in this category is just don't miss a payment. Set automatic payments up for every single line of credit you have, whether it be student loans, whether it be car loans, whether it be personal credit card debt. Set up automatic payments so you don't mess up, because if you miss one payment, it can take upwards, depending on how many lines of credit you have, it can take upwards of 4 years to get that missed payment off your record. And one missed payment can drop you from an excellent category down to average or poor, or even to very poor, which can really affect your credit score. Moving on to category number 3, derogatory marks. This is another one that you can't really correct. You can work with the bank on it if one of your lines of credit did go into collections. It's another one that will really affect your credit score. So my best suggestion on this is to not have a credit card go into collections. This is more of a proactive category. There's not really a workaround on this. There's not really a way to correct it besides working with the specific bank to create a plan to pay off that credit card or that line of credit. This is more of a proactive step in just making sure that you don't have any credit card go into collections. A good way to ensure this is just try to hit your minimum payments each and every month. Now, the fourth thing is the age of credit. This isn't gonna be a category that you can really improve your credit score on, but if you're trying to build your credit for long term, trying to get that best credit score possible, basically, this is something that I just learned this weekend. In order to get in this excellent category, you're gonna want your credit to be at least 9 years old, which is crazy because this category basically averages out all of your credits. So if you have, you may have like one credit card that's 10 years old, but if you have 2 credit cards that you open up this year, you average those out. So let's say I have one credit card I opened 10 years ago and one that I opened just now. Your average line of credit is going to be 5 years old. So this is more of a plan if you're younger, if you're in your teens, or if you're in your early 20s. A good way to do this is start opening up credit cards now. Let them season for a little bit, because after 9-10 years, you're gonna be in the excellent category. Now, like I said, this isn't really a category that you can really correct, but if you are looking long-term and you are younger, I would start opening up some credit cards now, making sure that you're obviously in a good place financially and have a good financial mindset so you don't get lost in the lines of credit and you don't start falling behind on payments and you don't start using more money than you actually have in your account. I would suggest opening up some lines of credit now, or if you're really young, get on your parents' credit cards, have them open up an account under their name, because I do believe if you open up an account under your parents' name, you basically get their season credit, or you basically get whenever they open up their lines of credits, and it's considered under your name as well. So that's a category right there. If you guys are younger, this will really help you out. Now, the fifth category or factor is the total number of accounts that you have under your name. Right now I have my mortgages, I have my car loan, and I have like 5 personal credit cards. Now, a lot of people think the more credit cards you have, the worse it looks, but it's actually better. If you think about it, if you have someone that has 10 credit cards and then you have someone that has 1 credit card, but the person that has 10 credit cards has been paying it off each and every year, hasn't missed a payment history, compared to the person that has 1 credit card who may have done the same thing, hasn't missed a payment. The person with 10 credit cards looks like they have a better financial situation, looks like they handle their money a little bit better, just because you have that many lines of credit and you're still paying it off each and every month. So if you really think about it, you can have a lot of credit cards, pay them off on time, and it looks really, really good. Now, that doesn't mean you should just go open up a bunch of credit cards right now, because if you open up a bunch of credit cards or lines of credit right now, short term, it will drop your score quite a bit, which leads me to my 6th category. And the reason why opening all these credit cards all at once will affect your credit score is because they are considered hard pulls, or the sixth category is total inquiries on your account or on your credit. Now, there's two different categories, like I said in the beginning of this video. Soft inquiries. Now, a soft inquiry is basically someone pulling your credit, but you're not looking to open up a line of credit. Good examples of this are like pre-approval letters for a mortgage. You're not actually applying for a line of credit right then and there, so it's just a soft pull, which doesn't affect your credit score. Maybe you're applying for renting a house and they just want to check out your credit score, but you're not applying a line of credit through them. That's a soft pull. Now, hard inquiries or hard pulls are you applying for a line of credit, car loan, personal credit cards, student loans, mortgage payments, or mortgage, excuse me, on a house. These are all considered hard pulls, and these will affect your credit. Now, the good interesting thing about this specific category is all these inquiries, they won't stay on your credit long term. They usually only affect your credit score for 1 year, and then after 2 years they pretty much disappear. So if you guys don't have anything that you want to apply for, if you guys aren't trying to apply for a house or a car loan within the next year or two, opening up lines of credit right now, credit cards may help you, because yes, it will affect your credit term, it will affect your credit short term, but then you also have all these new lines of credit opened up. So after that 2 years is over, they'll all disappear. All those hard pulls would disappear from your credit, but then you also have these all new lines of credit, which obviously will help your credit score if you are being responsible with them. So it just really depends on how fast you're trying to improve your credit score, if you're in this for the long term. So to sum up this video, I'm gonna give you guys my top tips in order to improve your credit score fast, and then also some ways to be proactive if you're younger to get that best possible credit score down the road, 5-10 years down the road. First thing, credit utilization. This is gonna be the most important thing as well. Pay off your cards early. This doesn't have to have an effect on your actual spending or your cost of living or the way you live. It's just making sure that you're not going over your credit utilization each and every month. So if you guys wanna do the math right now on your credit cards, see what you did last month. See if you're in that, if you're under that 30% range. If you guys notice that you're spending half of your credit card limit each and every month, I would focus on prepaying your cards off early. Second thing, don't miss payments. Now, there is a way around this. I don't really suggest doing this, but if you guys do have a couple missed payments, the more lines of credit you have, the more payments you have each and every month. So if you are starting to pay your cards off on time each and every time, and you have one missed payment you kind of want to get rid of, the more lines of credit you have, the more on-time payments you're making, and it'll kind of flush out that one missed payment. Sorry guys, I don't know, this is gonna be so hard for me to edit because my camera keeps dying. It's died 6 times in this video so far. So the third one is pay your minimums. If you know you're not gonna be able to pay in full, pay your minimums so you avoid those derogatory marks and your missed payment history. Paying your minimums will at least skip those two categories. You won't get hit, you won't get marked for derogatory, it won't go to collections, and you won't have payment histories. Yes, if you're not paying it in full, you will start accumulating some of that balance on your credit card, which is never good just because those interest rates are super high. Now moving into some of the things you guys can do to be proactive. If you guys know you're not going to apply for something right away, I would maybe open up a couple lines of credit, build your credit cards, get the total amount of accounts you have under your name up a little bit, because once those are seasoned a little bit, once you have 5-10 years, your credit score will start to shoot up automatically, as long as you're making payments on those each and every month on time. If you wanted to, doing this all in 1 year, yes, it will have a big impact on your credit score short term, but like I said, if you don't plan on using your credit score anytime soon, doing it all at once will really help you, rather than opening up a credit card each and every year. Because if you open up one this year, it's going to ding your credit. You open up one next year, it's going to ding your credit. Open up one next year after that, it's going to ding your credit. And then also on top of that, the average age of your credit cards is going to be spread out over that time frame. So that's pretty much it, guys. I hope this helped. I don't know how this video is going to turn out. I have a lot to edit right here, but I want to thank you guys so much for watching. Drop a like, let me know what you guys thought of the video, if I explained it well enough. If you guys do have any more questions, I love to help you guys out. The more questions you guys ask, the more research it forces me to do as well, and I love learning, so I'm happy to answer your guys' questions. And if you guys do want a free stock for just signing up, you guys can use the link down below for Robinhood. A lot of you guys are probably familiar with Robinhood. It's basically a brokerage. I actually just opened up my account a week and a half ago, and I just love the user face on it. It's absolutely amazing. One free stock for literally signing up, linking your bank account. You don't have to deposit anything whatsoever. You get one, I get one. It's a win-win, and that's it. So I'll see you guys in the next video. Let me know if you guys have any video suggestions as always, and please drop a like if it helped you even in the tiniest way. So I'll see you guys soon.